why DRs are more beneficial in a dual listing structure than a typical ordinary share dual listing structure. What you would normally see with a dual listing by way of ordinary shares is that you have two share registers that trade completely independently of each other. And what happens, in fact, is that you fragment liquidity because these two registers are independent. And even between two efficient markets, to move shares cross-border is an extremely cumbersome, time-consuming exercise that takes on average between 4 to 6 weeks in two efficient markets, let alone between one efficient and one inefficient market. With the DR, the movement of shares cross-border is seamless. So DRs are the easiest mechanism to transfer shares cross-border. That is one of the reasons why a dual listing by depository receipt is the most effective and efficient mechanism to facilitate your dual listing. Shares get locked up when you try to move them across border, and what ends up happening is a buyer moving shares onto another register cannot in fact sell for 6 weeks until those shares are reflected on that register. What we're also seeing is companies shying away and moving away from dual listings because they are admin intensive. What happens with the dual listing by DR is in the DR market, the issuer will only see BNY Mellon, so they only see one shareholder. We would then extend voting. If voting is being extended into that country, we would receive the dividend. If it was, for example, a Canadian issuer paying us a dividend in Canadian dollars, we would do the conversion to Zambian kwacha and pay out the Zambian investors in terms of their dividends. So the issuer in Canada would only see BNY Mellon being the one shareholder, so it eases the admin burden on those companies. And finally, one of the most important reasons for the African market specifically is that a lot of the companies are too expensive. If you look at First Quantum Minerals, which is the company that did the first Zambian depository receipts, they were trading at 140 Canadian dollars at the time of listing. It would have been far too expensive on a one-for-one basis into the Zambian market. It wouldn't have appealed to the retail investor market, and as a result, there wouldn't have been much liquidity in the stock. So what we did in that instance is we used a DR ratio where we had 140 depository receipts equal to one ordinary share. So a Zambian buying one depository receipt was effectively buying a $1 instrument. And to my mind, that is one of the most important reasons why the DR mechanism is used in these markets.